Welcome to the Property Code. I am your host, Nick. In today's episode, we delve into advanced real estate investing strategies that will define success in 2025. We will follow the journey of Logan, a 40-year-old technology entrepreneur who had already built a solid portfolio of rental homes. Yet as markets evolved, he realized he needed more sophisticated approaches to continue scaling. Through his experience, you will learn cutting-edge techniques suited for today's hybrid work trends, sustainable building practices, and technology-driven analytics. Logan began his real estate career with single-family homes in growing suburbs, but by 2025, he sought to navigate more complex deal structures. After selling his first tech startup, he decided to diversify into commercial acquisitions. His first advanced move was acquiring a small strip center anchored by a local grocery store in a secondary city. He noticed that as remote work took hold, mixed-use neighborhoods with essential retail remained resilient. Instead of targeting high-profile downtown malls with stiff competition, he focused on properties in communities where strong local income and stable traffic came from both in-person and online orders with curbside pickup. To analyze the strip center's potential, Logan used an artificial intelligence platform that aggregated historical sales data, foot traffic metrics from mobile device, location services, and demographic shifts. This data revealed that foot traffic was projected to increase by roughly 8% annually as the city invested in pedestrian-friendly corridors. Meanwhile, new distribution hubs nearby signaled rising warehouse demand, attracting workers who needed convenient shopping. By combining these insights, Logan gained confidence that rent growth would outpace inflation even if vacancy rates fluctuated. He structured the purchase via a Delaware Statutory Trust, allowing him to pool funds with other accredited investors for tax-efficient fractional ownership. This structure reduced personal liability and simplified management. Under this arrangement, each investor held an undivided beneficial interest, and decisions were made by a trustee experienced in retail management. Logan contributed a down payment equal to 25% of the acquisition price, satisfying the trust's target leverage ratio of 75% loan to value. The lender underwrote the property based on stabilized net operating income, accounting for both existing tenants and projected market rents. Once the acquisition closed, Logan implemented a value-add strategy. He negotiated new leases with tenants whose rents were below market, adding annual escalations tied to the consumer price index. He introduced sustainable upgrades such as converting the rooftop to a solar array and installing electric vehicle charging stations in the parking lot. These improvements qualified the property for green building incentives and increased its appeal to environmentally conscious tenants. As energy costs rose, the solar installation reduced operating expenses by nearly 20%. Moreover, new tenant mix included a boutique fitness studio and a specialized coffee roaster, both attracted by the property's sustainability profile and collaborative marketing efforts funded by a tenant improvement allowance. Simultaneously, Logan explored opportunity zone investments. He identified a mixed-use redevelopment site in a qualified low-income census tract, where local government incentives offered deferred capital gains if he invested within 180 days of sale. He sold shares of a prior property to realize gains, then directed the proceeds to a newly formed fund dedicated to developing environmentally friendly workforce housing. This project paired tax deferment with community impact, as half of the units were reserved for essential workers earning below area median income. By 2025, the construction wrapped up and the property delivered a blended yield of nearly 8%, exceeding his initial underwriting assumptions. Throughout these ventures, Logan maintained strategic partnerships. He collaborated with a regional fund manager specializing in adaptive reuse projects, transforming obsolete industrial buildings into creative office spaces. In one case, they converted a former brewery into a co-working campus featuring rooftop gardens and electric bike charging docks. The repositioned property attracted technology, startups, and design firms, capitalizing on 2025's trend of hybrid teams seeking flexible, wellness-oriented work environments. Logan invested through a joint venture, contributing equity and receiving an ownership stake proportionate to his capital and operational responsibilities. Another advanced strategy Logan deployed was securitization of his multifamily portfolio. He grouped 4 apartment complexes with consistent occupancy rates above 93% and pooled their cash flows. Working with an investment bank, he issued a real estate revenue note backed by those properties. The structure offered institutional investors access to stable income streams while providing Logan with liquidity to recycle capital. With interest rates for these notes set at a slight premium over 10-year treasuries, he effectively locked in low fixed cost and created a new source of funding to expand into emerging markets. Risk management remains central to Logan's approach. He maintained robust insurance coverage, including protect policies against environmental liabilities and natural disasters. Using predictive analytics, he monitored climate risk data to adjust coverage and set aside reserves equal to 6 months of debt service for each property. He routinely stress-tested his portfolio models, simulating scenarios such as economic downturns, shifts in demand due to remote work, and rising construction costs. This preparation ensured that he could absorb short-term shocks without jeopardizing long-term growth. As the year ended, Logan evaluated his performance by tracking metrics like internal rate of return, net asset value growth, and debt service coverage ratios. His combined strategies, fractional commercial ownership, opportunity zone development, adaptive reuse joint ventures, and securitization, delivered a realized portfolio yield approaching 9%. He reinvested profits into emerging market condominium developments in secondary coastal towns, anticipating further remote work migration and vacation rental demand. He also began exploring tokenized real estate platforms where blockchain-based tokens represented shares of high-value industrial parks, offering unprecedented liquidity and fractional access. Logan's journey demonstrates that advanced real estate investing in 2025 requires a blend of data-driven decision-making, creative capital structures, and an eye towards sustainability and hybrid lifestyle trends. By pursuing diverse strategies and leveraging technology and partnerships, investors can scale beyond single-family rentals into institutional caliber portfolios. If you are ready to elevate your real estate game, consider opportunities that align with these principles and build a roadmap tailored to evolving market dynamics. Thank you for listening to The Property Code. If today's insights spark new ideas, subscribe and leave a review. Until next time, stay innovative and keep building your future.